All right, so here's something that's, every mortgage is structured the exact same way. You have the price that you're going to pay and you've got the interest rate, and it goes in a sliding scale. So the higher you want to pay in costs, the lower the rate that you're going to get. But you got to look at it this way. It's like playing a game of poker. If any of you guys have ever gambled and you think about it, you've got $6,000 worth of chips sitting on the table, and you've got a choice here. You can play all in on that $6,000. And if you do, you lose the very first hand. Those are the hard costs that you just paid. But in return, you're going to win $100 for every hand that you play. Now, you can play as long as you want, 30 years, but you can only play one hand a month. So the question becomes, how long is it going to take me to win my $6,000 back? Well, it's easy math, right? $100 a hand, it's going to be 60 hands. 60 hands divided by 12 months, it means it's going to be 5 years. So it's going to take you 5 years to win back that $6,000 you paid in hard costs. Now, option number 2 is you can say, well, I'll keep my $6,000 here with me on the table, and I will lose $100 every hand. And what you do is you keep that money, you take a higher interest rate, you don't pay any closing costs at all, but the net result is your monthly payment is $100 higher. And the reason you do that is because you go, well, I'm not sure how long I want to sit at this table. Do I want to sit here for 5 years just to win my money back? Because if you end up, now the average, Fannie Mae was founded in 1968, Freddie Mac in 1970. They've been tracking this, and the average lifespan of a loan, of a mortgage, most of them 30-year fixed, is about 4.2 years. So it's easy to figure out what they are for you. You can just look at how many homes have you owned and how many mortgages you've had in each house. So you bought a house, you lived in it for 8 years, you refinanced once, for example. That's 2 loans in 8 years, you're at 4 years. Then you bought another house, you're in it for 10 years. So you've got 3 loans now in 18 years, and you refinance, and we do the math. So the average is about 4.2 years. So let's go back to this poker game. If you didn't go all in with the $6,000 and you kept this mortgage for the average of 4.2 years, that means you played about 50 hands before you got up and left the table, which means you still took $1,000 of chips with you because you weren't playing the game long enough to either spend that money or to win it back. Make sense? So that's how all these loans are work. Let me show you something. What we do is we look at that. We actually pull up the back room, and I'll show you what the market does, and we throw it into this analogy. So let me show you what I mean by this. So what I did is I just took a traditional $500,000 purchase, putting 20% down. Credit score is going to be right around where the national average is. We'll use 740 here. None of this stuff matters. It's all just for example. Everybody's got their specifics, right? So now look at this. Here's what we got. If you were going to borrow $400,000, for example, you've got a difference. The loan amounts are the same, but I structure these as far as a long, medium, or a short-term option. So the long-term option means you're all in with your $6,000, and you will win that money back over time. The short-term option is you're not going to play that first hand. You're not going to lose any money. You're going to lose a little bit every single hand that you play because you're not sure how long you want to sit at the table. So there is a break-even point. There always is. So when we look at this, the interest rate, the loan amount is always going to be the same. The term is always a 30-year fix. The closing costs, the cost of your appraisal doesn't change, the title work, all that kind of stuff, and we're just going to use we'll use $3,500 here. So that's about what it would be. And then how much do we want to spend to buy down the interest rate? So at 3.99, it would be about $6,000. At 4.49, it would be, you'd actually get a rebate of about $380. And then at 4.875, you're going to get about $3,900 in rebate coming back to you because you're taking a higher rate. So the costs are not only, there's no cost, but there's a credit that would come back to you. So in this scenario, it's easy for us to do the math on it. We just simply look at it and say, okay, how long do you anticipate being in this mortgage? Not in the house, but how long do you plan on having this mortgage in place? And where's that break-even point? So what this shows us is for the first 3 years, the absolute cheapest, best deal for you is the highest interest rate, 4.875. People that, I've got one company, and usually the average stint at in one position is about 3 years, and then they get promoted and move on. So they want to keep this money on their table, and they'll pay out the $100 a month or whatever it may be, because they won't plan on being there for 5 years. For the first 4 years, the interest rate of 4.49, so the higher rate and the medium rate, are cheaper than the lowest possible interest rate. What this tells us is you must be in this mortgage for a minimum of about 5 years just to win your money back. So we look at this on, it's kind of like if you see the car loans on TV, those advertisements, and they say, well, what do you want? Do you want 0% financing or $2,500 off the price of the car? The $2,500 is the cost of financing. So if you set this up, say, well, you know what? I want the lowest possible price. I don't care what the cost of financing is because I'll pay this car off early. You don't want 0% financing. You'll never recoup those costs. Does that make sense?